Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. What are debits and credits? Debits and credits are the two main accounting tools used to record business transactions. They are based on the double-entry accounting system, which means that every transaction affects at least two accounts and has a debit and a credit entry. Debits and credits are not positive or negative values, but rather opposite sides of the same equation. The equation is assets equals liabilities plus equity. This equation shows that the total value of a company's assets is equal to the sum of its liabilities and equity. To keep this equation balanced, every debit entry must have a corresponding credit entry, and vice versa. The debit entry increases one account, while the credit entry decreases another account. The effect of debits and credits depends on the type of account involved. There are 5 main types of accounts: assets, liabilities, equity, revenue, and expenses. The following table summarizes how debits and credits affect each type of account. Account type: increased by, decreased by. Assets: increased by debit, decreased by credit. Liabilities: increased by credit, decreased by debit. Equity: increased by credit, decreased by debit. Revenue: increased by credit, decreased by debit. Expenses: increased by debit, decreased by credit. For example, if a company buys a machine for $10,000 cash, it records a debit of $10,000 to the machinery account, an asset account, and a credit of $10,000 to the cash account, also an asset account. This transaction increases one asset, machinery, and decreases another asset, cash, by the same amount, keeping the equation balanced. Another example is if a company sells a product for $5,000 on credit, it records a debit of $5,000 to the accounts receivable account, an asset account, and a credit of $5,000 to the sales revenue account, a revenue account. This transaction increases an asset, accounts receivable, and increases equity, sales revenue, by the same amount, keeping the equation balanced. Debits and credits are essential for recording and reporting financial transactions accurately and consistently. They help maintain the integrity of the accounting system and provide a basis for preparing financial statements. Casual. Hey, do you want to learn about debits and credits? They are the basic tools of accounting that help us keep track of money flows in and out of a business. Let me explain what they mean and how they work. Debits and credits are entries made in account ledgers to record changes in value resulting from business transactions. A debit entry in an account represents a transfer of value to that account, and a credit entry represents a transfer from the account. For example, if you buy a computer for $1,000 with cash, you debit the computer account, an asset, by $1,000 and credit the cash account, also an asset, by $1,000. This means you increase the value of the computer account and decrease the value of the cash account. Debits and credits have different effects on different types of accounts. There are 5 main types of accounts: assets, liabilities, equity, revenue, and expenses. Assets are things that the business owns or has a right to, such as cash, inventory, equipment, etc. Liabilities are obligations that the business owes to others, such as loans, accounts payable, taxes payable, etc. Equity is the owner's share of the business, such as capital, retained earnings, dividends, etc. Revenue is the income that the business earns from selling goods or services, such as sales, fees, interest, etc. Expenses are the costs that the business incurs to generate revenue, such as rent, salaries, utilities, etc. The rule of thumb is that debits increase assets and expenses, and decrease liabilities, equity, and revenue. Credits do the opposite. They increase liabilities, equity, and revenue, and decrease assets and expenses. For example, if you sell a product for $500 on credit, you debit accounts receivable, an asset, by $500 and credit sales, revenue, by $500. This means you increase the value of accounts receivable and increase the value of sales. The reason why debits and credits work this way is because they follow the accounting equation: assets equals liabilities plus equity. This equation shows that the total value of the assets must always equal the total value of the liabilities and equity. Therefore, whenever a transaction occurs, there must be at least 2 accounts involved, one debit and one credit that balance each other out. This ensures that the accounting equation is always maintained. I hope this helps you understand debits and credits better. They are not so hard once you get used to them. Just remember that debits are on the left and credits are on the right, and that they have different effects on different types of accounts. If you want to learn more about accounting, You can check out some online resources or books on the topic.